Hi everyone. The market has been extremely volatile in the last 6 months to 1 year. Many stocks have corrected 60, 70, even 95% for few of the investors. The bull market has come to a kind of a halt and it's probably the start of a bear market. What caused these kind of turbulent times is primarily the fear of inflation, which has come real. The Fed rate hikes has happened globally. Every central bank is raising interest rates. How do we handle these kind of market crashes in the future and how to prepare ourselves so that we can take, in fact, advantage of such kind of crisis that comes along and how to rectify the mistakes we already did? Here are 5 measures. First one, do not invest the money that you need in the next 3 years in the markets because market can be really irrational for long periods of time than we can imagine. So it's a good idea to not have the money that we need the next 3 years in the markets. Give markets a long time horizon, like 5 year, 10 year, more the better. Second point, if we think we have made a mistake, it's a good idea to cut the losses. Many often investors tend to stay in the same stocks that is corrected, say 80 percentage. It could have been a fad in the last bull cycle and they will wait in the same stock so that it can recover back. And that's not a good idea to do because you don't have to recover the losses from the same stock. Cut the losses if you think you have made a mistake, and if you're not done the due diligence or if you don't have the conviction and you just invested based on some tips, it's a good idea to just cut the losses and move to a better quality company. Especially during these times, even the quality companies have corrected 50, 60%. So a great opportune time to consolidate your portfolio. Third, focus on the long term fundamentals of the business because 95% of the time your returns in the stock is driven by the business fundamentals and only 5% of the returns is determined by the valuations and your buying decisions at different points of time. What I mean is, if you had invested in a stock for like 15 years, the company's earnings will drive 95% of the returns during those 15 years and only 5% of the time is determined by the valuations at which you buy and the buying decisions you take at different points of time. Then fourth point is always have some cash aside, like 10%, 15% of your portfolio, so that you can take advantage of these kind of tumultuous times where the stock prices comes down significantly and you get the same companies at much bargain prices. Fifth point, focus on the process than the outcome. So the process is the key. Focus on the fundamentals of the business. There is a business behind those stock tickers. And if the fundamentals are intact, the stock is going to retrace back to its value. But many other stocks that has been the fad in the last cycle, or the stable coins or the EV names or the e-commerce name, whatever, they might not even come back to those levels, retrace back to its levels if they're not backed by the fundamentals. So focus on the process. Valuations are important. It's not that it's not important, especially the shorter time duration you have, the more important valuation comes into the place. Now, how do we invest in these kind of turbulent times when there is so much heightened inflation across the globe? Now, inflation could be transitory or not. I'm not an expert on that, but how do we invest during these kind? How do you prepare our portfolios to handle the inflation fears? The best idea is to invest in stocks that has pricing power. What is pricing power? Pricing power means a company that has the ability to increase its prices for the goods or services for that matter as they want so that they can pass on the inflation to the end customers. I'll tell you an example. Netflix recently raised their membership subscription prices, and Amazon Prime recently raised their prices. But we are not going to cut the Netflix or Amazon Prime membership. Most of the people will not cut the membership or subscription just because the price increased by a couple of dollars a month. So that is a pricing power. And many often some of the manufacturing companies also have pricing power. It's not that it's always a consumer name that'll have a pricing power. For example, if a company is a low cost manufacturing company, say based out of India, that is manufacturing pharmaceutical APIs or pharmaceutical ingredients, they might sometimes have the pricing power to or the ability to pass the increase in raw material prices due to inflation back to the end customers. So do the analysis and see what kind of companies you are picking in your portfolio, and those companies at least have great pricing power. At least percentage, like half of your portfolio has such kind of companies. It can handle the volatility driven by the inflation. So that is what I wanted to bring today. Thanks for staying with me. Signing off, Sandeep Anand.